much for having me. I deeply appreciate it. And let me get the show on the road. What I'm going to be dealing with is really looking at a comparison as far as the Great Depression of the 1930s to the financial crisis of 2008, 2009. There are a significant number as far as comparisons between the two. And when I was doing my research for this initially, I thought it was, excuse the expression, quite shocking and quite important as far as what's been going on. The first part of my presentation is going to deal with the Great Depression and its ultimate impact on American workers. This slide that you're seeing is the iconic photo that was taken by Dorothea Lange. The title of it is Migrant Mother, and it depicts a destitute pea picker. That's what she was. She was a pea picker in California, and her name was Florence Owen Thompson. She was 32 years old. She was a mother of 7 children. This was in California in March 1936. And if you want a definitive photograph as far as what was going on at that point in time, I think this is the best one to use. While we're dealing with as far as the Great Depression is concerned, what is seen on this slide are 2 distinct photographs. One at the beginning, as far as the crowd gathering at Wall Street and Broad Street after the 1929 crash. And then the other side shows an impoverished American family that's living in a shanty in 1936. That's how things had gone bad so fast in such a relatively short period of time. Now, in order to get an understanding as far as what occurred, the Depression didn't begin until about 1929 with the fall of the overinflated stock market. In fact, the Depression had begun some 10 years earlier in Europe. And as the Depression raged on in Europe, Americans believed that they'd be immunized as far as their effects are concerned. There were isolationist sentiment and conservative doctrine that held that the less we have to do with Europe, then the better we would be. As a result of this, the American policies never really addressed the possibility that the United States could be getting into a depression also. The American policies actually contributed to our entry into the Depression. You have to go back to the 1920s because that was a period of time in which the economy was really taking off. It was doing very, very well. But it was a house of cards. It was a house of cards because of the fact that the US economy, being largely a consumer-based economy, was investing, but they were investing in common stocks, and it's basically being done on margin, that is buying stocks on credit. We'll get more into that later on, but we're talking about the idea that the whole 1920s could be regarded as one big party. And it was a party in which nobody wanted to leave, but it was a party in which, while the economy was taking off, it was taking off under false pretenses. Well, another thing that occurred that was very important was Black Tuesday. And this is where stock prices collapsed on Tuesday, October 29th, 1929. Despite the dangers as far as speculation, many believe that the stock market is going to continue to rise on forever. And on March 25th, 1929, after the Fed warned of excessive speculation, there was a mini crash that occurred as investors started to sell stocks at a rapid pace. They exposed the market's shaky foundation. Selling just intensified for the rest of the year until about mid-October of 1929. On October 24th, known as Black Thursday, the market lost 11% of its value at the opening bell on very heavy trading. This huge volume meant that the report as far as prices on the ticker tape in the brokerage houses around the nation was hours late. So investors had no idea that most stocks were actually trading at their moment. It increased the panic. So Black Tuesday was very bad because you had about 16 million shares that were being traded because of panic selling. And that's when it actually reached its peak. So Black Tuesday was possibly regarded as the worst day because the Dow lost about 30 points or about 12%. People had lost complete confidence in the market and they weren't going to be investing anytime soon because of the nosedive that the market was taking. There was also from 1929 to 1933 what was known as the Great Contraction. What we saw here, or what the United States saw here, is a situation in which the US economy actually went down. For example, by 1933, the country's gross domestic product had declined by 30%. Production of consumer durables fell by 50%. Producer durables had fallen by 67%. New construction had fallen by 78%. And gross private domestic investment had fallen by almost 90%. US imports and exports dropped by about 40%. Unemployment had reached its peak in about 1932, 1933 of about 25%. So we're talking about the idea from 1929 to 1933, the economy just collapsed. People weren't buying, people were out of jobs, and the economy literally just stopped and grounded to a halt for about those 4 years. And we're talking about the idea that not even the Federal Reserve was going to be getting involved. They felt, the economy needed to slow down. The economy was pretty much on its own. And that's when you had the Federal Reserve that was making things worse by even increasing interest rates. So the Great Contraction was just that. The economy literally shrinking before everyone's eyes. The timing and the severity as far as the depression is concerned was really, really bad because of the fact that we're talking that the economy had gone from a period of a very high to now a period of a very low, if I can use that term. For example, in terms of the severity, automobile sales declined below the levels of 1928. Prices began to decline. Wages held steady in 1930, but they had a deflationary spiral starting in about 1931. Farmers had it even worse because you had declining crop prices. The Great Plains was crippled by a devastating drought, and the economic outlook just kept getting worse. 10% during this period, 10% of all Great Plains farmers had changed hands despite federal assistance. So we're talking about the idea that the economy just kept getting worse. And the severity was that about 13 million people were unemployed in the United States. Industrial production had fallen by nearly 45%. Home building was falling by 80%. More than 5,000 banks failed. The stock market had lost about 90% of its value, and over 1 million families had lost their farms. Now, if you want to get a better understanding as far as the Great Depression is concerned, there were many causes. This was actually a perfect storm type of scenario in which you had a lot of different factors that contributed to the nation's economic and financial collapse. What you're seeing here is a bank run occurring in the Midwest about the year 1933. And by the way, in 31, 32, going into 33, there were significant numbers as far as bank runs are concerned. Now, in terms as far as the causes, one of them was protectionist trade policies of the Smoot-Hawley Tariff, 1930. The economy had collapsed, and Hoover and his administration felt that the best way to try and get things going was to stop importing and to start having literally a trade war. And that meant raising the tariffs on goods that were coming into the United States. Here's the problem. Other countries around the world started raising tariffs on American goods. So, for example, American farmers, American manufacturers couldn't sell their products overseas because countries overseas were raising these tariffs, and countries overseas were not going to take in American products. So these protectionist trade policies under Smoot-Hawley tariff only made things worse. We couldn't sell anything overseas, even if we were trying to give it away. Incorrect Fed policy, what the Fed was basically doing was raising interest rates. The Fed felt there was too much money going around in circulation. The Fed felt that in order for the economy to get up and going, you had to lower the amount of money in circulation. This was the wrong idea. This was the wrong policy, because what generally happened was that without any money moving around in the economy, companies couldn't borrow money, not for the short term and not for the long term. And on top of that, the Fed was not lending money to banks, was not trying to help banks. The Fed was basically saying, you're on your own. And this contradicted Fed policy of lender of last resort. The bank system collapsed in the sense that banks were just started closing. People were drawing their money out, people were taking their money out. And so therefore we had a situation in which the banks just couldn't function anymore. Because the banks couldn't function anymore, banks collapsed. They had bank runs, just as you had seen in that photo before. And we're talking about the idea that it just got worse and worse as far as the banking system is concerned. People were literally taking their money out, what they could, and they were burying it in the backyard. They felt that was the best way as far as being able to protect their money. Stock market crashes. We're talking about the idea that investors were basically losing significant amounts as far as returns on their money. And at the same time, they had lost billions of dollars in terms of the amount of money they had invested. One of the key things you have to understand during the period of the 1920s was that there was significant amount as far as speculation is concerned in stocks. And one of the ways to do speculation in stocks is margin buying. Margin buying is the idea of buying stocks on credit. You'd borrow the money from your broker. Margin buying works. It has worked in the past. It can work, but it can only work if the stock price continues to go up. If the stock price takes a nosedive, goes down, then we're talking about the idea that the investor has to meet what's known as a margin call that the broker would make, and say, the broker would basically say to the investor, your stock has lost value, it's losing value as far also as the amount of money that we've lent you to buy the stock, you're going to have to make up for this loss. A lot of times these investors didn't have the money to make up for this loss. So therefore what happened was that stocks had to be dumped, and they were dumped really fast, but at a significant loss. And because of that, you had a lot of investors that were just running out of the market because they just couldn't meet the margin calls. Farmers were getting hurt because of the fact that they had started suffering severe economic crisis a few years earlier because crop prices were going down. Because crop prices were going down significantly, these farmers were really, really scared because they couldn't get the prices they needed for their crops. And because they couldn't get the prices they needed for their crops, they were operating at a loss. They were operating at a loss, and this basically meant that these farmers had to go out of business, and they lost their farms to foreclosure. They lost their farms to banks. And that was a big, big problem because low crop prices meant that farmers could not sell their crops at a profit. They couldn't sell their crops at a profit. They couldn't meet their mortgages. They couldn't meet their mortgages. They went into foreclosure. So farmers, they were hit hard, but they were hit first. The roaring 20s occurred where you had an economy that was doing very, very well. You had an expanding, a booming consumer-based economy, and people were buying things. And the economy was growing at a significant rate. But it was also known as easy money because interest rates were fairly low. because interest rates were fairly low, it allowed as far as people to borrow as much as they wanted. And they didn't really have to worry about the banks getting on their case about collecting because the economy was booming at a significant rate. Income and wealth inequality, the problem here was that you really had two different groups in the United States. For example, the richest 1% owned 40%, they had 40% of the nation's wealth. The bottom 93% actually saw a 4% drop in real disposable per capita income between 1923 and 1929. Worker productivity really rose during this point in time between 1919 and 1929. But however, as the economy dropped in the 1930s, you had people losing out as far as income, as well as losing out in terms of wealth is involved. There was the use of the gold standard in which more Americans started to hold gold, wanted to hold gold, and the Fed would have a substantial amount as far as gold is concerned. And that's how the value as far as currency was depicted, was the value and the amount as far as gold that was being held. Now, there's some interesting charts that I've run across about showing what was going on in the economy from about 1929 to about beginning of World War II. From about 1929 to about beginning of 1933, the money supply in the United States actually saw a big drop. You had people who either had lost their money or were talking about the idea that people were taking their money out of banks. They were taking their money out of circulation altogether. So that's why you see a big decline as far as the money supply is concerned. However, starting about 1933, Roosevelt gets into office, the United States government puts more money into circulation. You start seeing more money get into circulation in the economy. And that's why what's kind of significant is going into 1940, 41, 42, you saw a significant amount of money going into the US economy. This was mainly because as far as the United States government was spending, and they were spending a lot. In terms of Wall Street took a big nosedive. It wouldn't be until the 1950s that Wall Street started actually seeing a return. This is the Dow Jones Industrial Average from about as far as 1929 is involved, all the way to about 1930. The thing is this, that we see that the Dow Jones Industrial Average takes a really bad hit, and people had lost faith in the market, had lost confidence in going into the stock market, and so therefore, such things, indexes such as the Dow Jones Industrial Average only went further down. Industrial production declined. If you're talking about four of the major economies, the US, Great Britain, Germany, as well as France, industrial production declined as well as wholesale prices. Companies couldn't even give their products away. They saw actually a period as far as the number of goods that they produced went down because there wasn't a demand for it. That was the key idea as far as demand. It started picking up toward the tail end as far as the 1930s are concerned, but it took a while. It took a good long while. Now, what we're going to be dealing with next is the actions by the government on the federal level and why. And this is the best way to depict it because you had two different presidents with two different policies, sets of policies. I think this next slide is pretty interesting because it shows the cover of the New Yorker, and it demonstrates the difference everyone knew that there was between Hoover, Herbert Hoover, Herbert Hoover, President of the United States, and FDR. It's kind of interesting because this was dated the day after FDR was inaugurated. Under Hoover, there were some significant factors that have to be taken into consideration. First, no government intervention. the Hoover administration did not want to get involved. They felt that it was best if government stay out and let business and charities trying to help individuals. Businesses would have to dig themselves out. If they fail, they fail, and charities would have to help people. Problem is that businesses kept failing, and charities just didn't have enough resources to help individuals. So you had Hoover's administration that really wasn't doing anything, not doing anything at all as far as trying to get the economy up and going. Prices were propped up. We're talking about the idea that the Hoover administration, they did increase spending to a certain degree as far as certain types of programs are concerned. But unfortunately, what they also did at the same time was raise taxes to pay for these programs. So propped up prices was the idea that the Hoover administration was trying to put some money into circulation. But the problem was, in order to pay for these programs, they propped up taxes. They really jacked up as far as taxes are concerned. That didn't help. The Hoover administration started the RFC. This was the Reconstruction Finance Corporation. It was the idea as far as to make emergency loans to businesses in danger of default. So they would lend money as far as railroads, maybe some banks, and certain agricultural organizations, but it wasn't enough. It just wasn't enough. And so Hoover tried to sign some other legislation that would go into effect and try to pump money into the US economy, but it just was too little too late. As I stated before, under the Hoover administration, the Smoot-Hawley Tariff Act was passed. And the idea was, well, in order to have Americans buy American products, we're going to put a tax on foreign goods, on anything that's imported from overseas. That didn't help because you had countries overseas that stopped buying American goods. The problem here is taxes, subsidies, and relief schemes, is that the subsidies and the relief schemes just weren't enough. The federal government just wasn't putting enough money as far as within the US economy is concerned. And to make matters worse, what the federal government did was they passed a tax act. That's right. They passed what was known as the Revenue Act of 1932, which doubled the income tax. And this has been the sharpest increase in the federal tax burden in American history. So what the federal government actually did under Hoover was to raise taxes. And this was a bad idea because it was taking money out of circulation. People were already hit hard, and now they had to pay twice as much taxes in the past. Other problems that occurred under this legislation is that the surtax was raised from 20% to a maximum of 55%. Corporate tax went from 12% to 13.75 and 14.5%. So there was a tax increase. Estate taxes were raised. Gift taxes were raised. And just a couple other points. There was a 10% gasoline tax that was imposed, a 3% automobile tax that was imposed. There was even a check tax. I'm not making this up. There was actually a tax on checks. You write a check, you had to pay a tax. So it was pretty bad as far as what the Hoover administration did and didn't do. Now, FDR was different. FDR put into play, as soon as he got in, what was known as the New Deal. The whole premise was, and he talked about this when he was running for president, the whole idea was that the American people needed a New Deal. And we're talking about the radical restructuring of government's role in the economy, that it would be involved more so in the economy than ever before in terms of a variety of programs, anything as far as trying to boost the economy is concerned. There was also what was known as the NRA, the National Recovery Act. That was formulated under the National Industrial Recovery Act. And the idea was to get business to regulate itself. It would ignore antitrust laws and develop fair codes of prices, wages, hours, and working conditions. Not only that, but now you had a minimum wage, which you haven't had before. And also such things as a 35-hour work week for industrial workers and 40 hours for white collar workers. By the way, there was also a ban on youth labor. The whole idea here was to give American workers a little more of a help through various kinds as far as legislation is concerned. There was also the Wagner Act and labor laws. We're talking about the idea of making it actually easier for unions to formulate, for unions in terms as far as organize, and to actually get people to join unions. This was a very pro-union type of legislation, and it helped workers, some would say, a lot of say, I say, as far as in the long run is concerned. There was also the Emergency Banking Act. Here, the federal government was going to get more heavily involved as far as banking is concerned and banking relief, such as FDIC, Federal Deposit Insurance Corporation. But not only that, but when FDR gets into office, he declares what's called a banking holiday, a bank holiday of 1933. The idea was to shut down the banks. Shut down the banks for a period of about a couple of weeks, 10 days. They would be examined. The good banks would be allowed to reopen. The bad banks would be either closed or they would merge with the good bank. But the whole idea was to shut down the American bank system and to do an examination of every bank. And if you're a badly run bank or you're in bad financial shape, just close you down permanently. If you were in good shape, you were allowed to reopen. Federal Emergency Relief Administration, the idea was to help the economy as far as different types of programs, because of the fact that you had businesses shutting down, you had individuals that were being thrown out of their homes. This was trying to help as far as businesses and individuals get back up on their feet. What FDR did was introduce also other programs and policies in subsequent years. A lot of them are still in force today, whether it's Social Security, minimum wage laws, FDIC, the Securities Exchange Act of 1934, Tennessee Valley Authority, even Truth in Securities Act. But a lot of these ideas that FDR put into play, they're still around today. And the whole premise was to help the country get back on its feet financially. What I want to get into next is a little bit more as far as the Depression is concerned, but I think this photo is very important because you had in Times Square, people would stand online for hours in order to try and get food. And this was prevalent, not just in New York City, it was prevalent across the country. And I think this photograph from 1932 really is very accurate as far as what was going on in the economy at that point in time. Now, in terms as far as the impact on American workers, the migrant farm labor really suffered because of the fact that they were the ones who couldn't get a job anymore. They couldn't work anymore. Farmers had literally shut down their operations. And so you had the migrant farm labor that went from farm to farm, but there really was no work to be had. Labor and employers got into it, and they had some really violent strikes. They had some very violent confrontations, and labor just said, you know, we're not going to take this anymore. They were frustrated. They see the economy is doing poorly. Either they are unemployed or they know somebody who's unemployed or somebody in their family is unemployed. So labor was going at it with the employers because they were saying basically give us jobs. There was some gains for women because of the fact that more men had been thrown out of work. Women had to go back into the workforce. And generally, a lot of them were the ones who were able to get jobs, while the men had to stay home because there wasn't any jobs or any work for them. Women were also cheaper, much cheaper than men. American farmers, as far as the reaction to farm foreclosures, in the spring of 1932, there were between 15 and 20,000 unemployed veterans that camped out in the park in Washington, D.C. They demanded full payment of their bonus promised them for serving in World War I. They were dispersed by the U.S. Army. And so, we're talking about the idea, we're talking about the idea as far as veterans were even becoming very, very much in terms of discouraged. Crime really increased. It went up substantially. And what happened basically here was that best way to try and make money, a lot of people felt, was just rob a bank or rob a store or rob other individuals. So this increase in crime was significant because people were just desperate and they were doing desperate things. The thing that really changed this whole situation was the election of 1932. By a wide majority, American voters booted out Herbert Hoover. They elected FDR, and he changed things. People started feeling better within a couple of years because they started seeing that the American economy got better. Probably the song that best typifies what was going on at that point in time was Once I Built a Railroad, I Made It Run. I made it race against time. Once I built a railroad, now it's done. Brother, can you spare a dime? The song was very important because it basically showed the frustration that people were feeling at that point in time. As I said, you have FDR get into office, and he literally changes things around with the programs. Not all of them worked. Even he admits it, that not all of them worked, but they did make significant changes in the US economy. Now, fast forward, let's go to the financial crisis of 2008, 2009. While the Great Depression lasted about 10 years, it saw millions of Americans lose everything they own, their homes, and also as far as their jobs are concerned. There was a lot of speculation that had been going on. But the financial crisis of 2008, 2009 had also some parallels with the Great Depression. For example, deregulation by the federal government for the securities industry. There were low interest rates for loans, personal and business loans. There was speculation in the stock market that traditionally didn't have any. Well, some speculation, but not as much because it became heavily regulated. But not only that, but there was speculation in the market that traditionally didn't have any speculation, and that was the housing market. And also there was substantial growth as far as the stock market is concerned. Now, in terms as far as what occurred, you have to understand that the roots and the origins could be with the US housing market. The housing market really took off. People were seeing that the value of their homes in a relatively short period of time was really going up. Because it was really going up, they were using their homes as ATM machines. They were borrowing money against their home. And when you have the housing market just literally see prices double in a relatively short period of time, that spelled trouble for the housing market. Households were borrowing from the originator, would it be the broker, or as far as the lending institution is concerned, they were borrowing significant amounts of money. They were taking this money and they were spending it in a variety of ways, but they were borrowing substantial amounts of money. Once the party had originated the loan, they would sell the mortgage to another financial institution. They didn't hold on to it because they wanted liquidity or because they wanted to get rid of a bad mortgage really fast. Originators of the mortgage would sell it to somebody else, and they would literally say, let it be somebody else's headache. Financial institutions issued mortgage-backed securities. We're talking about, for example, that bonds that held mortgages, and then the bond itself would be sold off to investors. The idea was that these financial institutions were trying to get cash for these mortgages and not have to worry about the fact that they might possibly default. Private financial sector issues collateralized debt obligations. These are basically bonds that were backed up by loans that had lent money for automobiles, real estate perhaps, or any other tangible items. Why is this important? Because once these loans started going bad, then we're talking about the idea that the borrowers couldn't pay back the loan, and that these mortgages started going bad within the bonds, and it would eventually cause the bonds to go bad. There was a substantial growth as far as credit default swaps. Now, not very many people are familiar with these. What a credit default swap does is that it protects, it acts as an insurance policy for a bond. So if you have a bond that's low rated and a high interest rate, a credit default swap would basically act as a type of insurance policy against the bond, for the bond, so that in case the bond would go bad, then you would have this insurance policy, the credit default swaps, that would back up the bond. The problem is that if you have a lot of credit default swaps, I mean a lot of them, in the trillions of dollars, then you're talking about the idea that it's a high amount of risk, a substantial amount as far as risk is concerned. One of the things you have to understand is that home prices really went up. On slide number 21, we're talking about the idea as far as the Case-Shiller Index, which is the red line. And that was an index that's still around today that was put together by Professor Case and Professor Shiller. And they were trying to show an index, or which way housing prices were going over a period of time, which way housing prices were going. And if you notice, in about April 05, 06, 07, we saw the peak. But then after that, in 2007, housing prices started to go down, and the Case-Shiller goes down. Case-Shiller Index goes down. So the whole idea is that you have this buildup, and then you have the sudden drop. This is how bonds worked at that point in time. See, basically what you had was, you had either a corporate borrower or a household borrower that would borrow money from a bank. What the bank would do is that they would sell it. They would sell the loans to a bond of some type, a residential mortgage-backed security, or a asset-backed security, or commercial mortgage-backed security. They would sell it to, as far as this bond is concerned, and then the bond was sold to investors. Investors would give over cash. They would buy it from whoever was selling it, and they were expecting to get the principal and interest as far as the bonds are concerned. Is this a problem? Yes, it's a problem because of the fact that once things started going down and more borrowers started to default on their loans, these bonds became worth nothing. They were literally, the ink was worth more than what the paper they were printed on. Stock market declines as far as about 2007 is concerned, 2008, and it takes a big, big nosedive. This is a reaction to what was going on in the residential housing market at that time. That people just got scared and they were banks were foreclosing on mortgages. Now, in terms as far as some key events that occurred, these are important. In April 2007, New Century. New Century was an American real estate investment trust. They specialized in subprime mortgages. They filed for Chapter 11 bankruptcy protection. The problem here is that New Century just invested in bad mortgages. Well, the problem was that nobody later on would take the mortgages. Nobody as far as wanted those mortgages is concerned. So what did they do? They had to file for bankruptcy protection. Lehman Brothers and Washington Mutual Bank, they declared bankruptcy. Nobody would come to rescue them. We're talking about the idea that they had gotten involved in bad mortgages. Washington Mutual wrote a lot of bad mortgages. So we're talking about the idea that individuals just couldn't afford to pay their mortgages back anymore. Washington Mutual goes under. They were bought up by Chase, but it was not only for a bargain price, but Chase was basically saying to the Fed, buy the bank, we just want the good stuff, the assets. Lehman Brothers had gotten heavily involved on speculative purposes as far as these credit default swaps, CDOs, and things of that nature. The Fed had to get involved in 2008, and they lowered interest rates or Fed fund rates to 0. It was the old idea that, we as the Fed will hold your money for you, banks, but we can't pay you any interest. We aren't going to pay you any interest. Dow Jones Industrial Average went to a bottom of 6,443. It was really pretty bad. That's about the floor. But we're talking about the idea that that's how things have gotten as far as within the markets are concerned. Now, in terms as far as the causes and origins, deregulation, the federal government really did a lot as far as deregulating. They took laws and they rearranged them, or they took the teeth out of existing laws. So that's a problem. It's a problem in the sense that these laws now didn't have anything to back them up. Deregulation did away with a lot of them. Securitization was the idea of taking bonds that were formulated out of mortgage-backed securities and making things such as mortgage-backed securities and car loans and even student loans and make them into securities. This was a relatively new idea, but also kind of dangerous too, because of the fact that securities were being created that had never been created before. Credit markets dry up. The problem here is that nobody was lending anymore. If you had anybody who was a lender, they were basically as far as not going to be lending. They decided they weren't going to lend anymore. That was a problem because businesses were saying, we need cash because we have getting orders from our clients, from our customers, and we need cash to keep it going. Well, the credit markets say, well, look someplace else because we're not going to lend you the money. Too much debt. Consumers had gone into too much debt. They borrowed too much on their home mortgages. They borrowed too much on their credit cards. They took out a lot of personal loans they couldn't pay back. The bottom line is that we're talking about people went into too much debt, either before, as far as the financial crisis are concerned, or during the financial crisis in order to pay for such things as groceries. There was financial innovation in terms of financial engineering and new types of financial products that had come out. The only problem is that they were new and they weren't tested when the economy was in bad shape. They were new and they weren't tested when the economy was in bad shape. So nobody had really any idea of how these things were going to operate or how they would function when the economy was in bad shape. And not only that, but a lot of these financial instruments are very complex. trying to get the average investor to understand what they're all about is very, very difficult. Incorrect pricing of risk is important because of the fact that you had a lot of pieces of paper that are out there, securities that were out there, that were not properly priced, taking into consideration such things as risk. Now, in terms as far as the mortgages, because mortgages played a big role in the financial crisis of 2008, 2009, there were a lot of what was known as subprime mortgages. That is, that mortgages were being given to people who shouldn't have gotten mortgages or shouldn't have had a mortgage to begin with. And the problem here is that these subprime mortgages were being given to individuals that were highly risky, that the chances of foreclosure or default was really, really pretty good. So banks did give these, and finance companies did give out these types of mortgages, but they shouldn't have. There were just too many individuals who had mortgages that shouldn't have had mortgages. The Federal Reserve the Federal Reserve Bank also raised rates in subprime mortgages. They were worried about inflation. They literally were trying to get rid of, as far as also those individuals who had borrowed money and they weren't in best financial shape. So what the Fed does is, as far as raising interest rates are concerned, on subprime mortgages. There was the growth of interest-only mortgages. Here, we're talking about the idea that you had a mortgage in which, as the borrower, you didn't have to pay any principal for a period of 7 years. You just paid the interest for the first, let's say, 7 years. The problem here is that you always have to hope and worry that the value of your property goes up. What we saw in the financial crisis of 2008, 2009 is that the value of property actually went down. And a lot of these people had to get out of their houses because they couldn't afford to keep them anymore. Housing market, as a result, takes a big, big decline. And we're talking about the idea that it wasn't just like different pockets in the United States. It was the whole country that was having a very serious time regarding mortgages. New Jersey got really particularly hard hit. So you also have to keep in mind that between 1994 and 2006, the average price of a single family home increased by 200%. That's from 1994 to 2006. But after that, we saw a really bad decline as far as the housing market is concerned from, let's say, 2006, from about 2006 up until about start of this year. Because now what we're starting to see is the residential real estate market go back up again. Now, this is an interesting slide provided by Statista. It shows the sales price of existing single-family homes in the United States from 2000 to 2017. Notice that the peak was about 2005 and 2006. Then after that, it starts taking little dives down. 2011 was probably the worst, but it starts moving up after that. This is important because we're talking about a large number of homes that are out there for sale, existing single-family homes. We're the ones that we're going to get hit particularly hard. Mortgage delinquency rates for subprime conventional loans. This is from the year 2000 to 2015. Notice that in 2009, 2010, even 2011, we're talking about the idea that these are the peak times. So there was a lot of delinquency that was going on regarding subprime mortgages. I mean, these were pretty bad mortgages to begin with. This only makes it worse. In terms as far as by mortgage type, probably the best mortgage to try and get as far as which one is going to have a lower delinquency rate, probably the best type to get is a fixed prime mortgage, which is good. And it's a better deal for the borrowers in the long run. The second best would be a prime adjustable rate mortgage. And then the others, you can see how worse they get over a period of time in terms of delinquency rates. Now, in terms as far as also the key numbers to keep in mind, there's a couple of them that I think are important. For example, $144.5 billion moved from money markets to treasury bonds. What we're talking about here is that you had a lot of money that was going from money markets that were paying relatively low rates to treasury bonds that were regarded as very, very secure and safe. But at this point in time, you had a lot of bailouts going on. You had a lot of money changing hands. And I'm not sure about the money changing hands, but the bailouts did help the US economy. There have been disagreements about them, but they did help the US economy. Now, how did the government react to the Great Recession? Basically, what they tried to do was pass laws, rules, regulations in order to not only help get businesses back on their feet and regulate them the way they were supposed to, but also at the same time, put money into the economy. And they did. The US government put trillions of dollars into the US economy to get it up and moving again, which in the long term actually did work. The Federal Reserve introduced something called quantitative easing. With quantitative easing, it's the idea that the Fed was buying up bonds, mortgages. They were buying up a whole bunch of stuff. The whole premise was they were going to buy this and then put it into circulation. So put the money into circulation. By putting the money into circulation, buy it up, pay money for these investment instruments, and this would put money into circulation, which helped in the long run. There were emergency and short-term responses as far as what the Fed did, as far as what central banks did around the world, and also as far as what the US government did. But the bottom line is that there had to be a lot of money pumped into the US economy in a relatively short period of time. Regulatory proposals, long-term responses, probably one of the most important was the Dodd-Frank Act. That was very, very important because it introduced a whole set of laws and rules and regulations that was broad in its scope, from credit cards, not only just the banks, but also insurance companies as well. So the whole idea was to try and put laws and rules into place that would actually help the US economy. Congress took a lot of action, Congress took a lot of action because what they primarily did was pass legislation in order to get the US economy back on its feet, but also do certain types of regulations so that there wouldn't be as much speculation as there was in the past. That is probably one of the big things. The speculation that occurred in the past, for example, on houses, that made the economy a lot worse than it should have been and put the economy in deep, deep hole. Now, in terms of bailing out the US financial system, the federal government had to put in literally trillions of dollars into the US economy in order to save it. For example, through new loans, purchases, and as far as the liabilities of the Federal Reserve, as well as the Treasury, as well as the FDIC, it totaled over $5 trillion. In order to bail out the US financial system from this crisis, you needed at least $5 trillion. For example, there was $1 trillion in loans by the Fed to broker-dealers through the Emergency Discount Window Program, $1.8 trillion in loans by the Fed through the Term Auction Facility, $200 billion for GSC government-sponsored entities by the Treasury, $1.5 trillion insurance for unsecured bank debt by the FDIC. So we're talking about the idea that it's not just hundreds of billions of dollars, but we're talking about trillions of dollars. If this $5 trillion was not put into the US economy, you would have had a depression. Now, the impact on the working people, for a variety of reasons, the American workers got hit bad. Spending changes. They cut spending drastically. American workers cut spending radically. They had to. They ran out of money. They just didn't have money. And we're talking about the idea that they were desperate. They needed cash. And they had to cut back as far as spending is concerned. If they couldn't get cash other ways, then we're talking about the idea that they were borrowing money, and they borrowed a lot of money just to keep afloat. We're also talking about the idea that they didn't retire. A lot of the baby boomers who could have retired didn't, because of the fact that they just couldn't afford retirement. So they just put off retirement. There was a significant amount of loss of personal wealth. We're talking about the idea in terms of money, in terms as far as money is concerned, leaving the markets, leaving the marketplace. And so therefore, wealth couldn't appreciate as it normally had done in the past. So there was a substantial amount as far as the loss of personal wealth. The financial services industry lost a lot of jobs. Some estimates say that as far as the New York metro area is concerned, they lost at least 100,000 financial service jobs. Lost at least 100,000 financial service jobs. And this is really kind of bad because of the fact that a lot of these jobs just never came back. You had investment firms that either closed up, they closed up permanently, or they moved to other parts of the United States that were cheaper. Well, the people who stayed behind, or the people who lost their jobs, these jobs are never coming back. So that's a problem. In terms of cost to taxpayers, $5 trillion is probably a good way of putting it, because that money that the United States government and the Treasury and the Fed and FDIC had to pump into the economy had to ultimately come from someplace, and it came from taxpayers. So if you're talking about a direct cost to taxpayers, $5 trillion is the price tag to get us out of the financial crisis of 2008, 2009. These next graphs are going to show you as far as how working people were impacted. For example, in terms of jobs, there were about 5.5 million jobs that were lost because GDP growth just plunged. I mean, it just went down because of the September 2008 crisis, of the financial crisis, 2008, 2009. So when you're talking about 5.5 million jobs, a lot of them never came back. Wages went down. American families lost $360 billion in wages and salaries because of the weak economy. We're talking about $3,250 per household in 2008, 2009. So the line going upwards is showing you as far as wages with the September 2008 forecast, but the dotted line shows this is what really happened. And that's sad because there were a lot of people who not only lost their jobs, but a lot of people who didn't lose their jobs, they also saw that their paycheck went down. This is the value of American families' homes as far as falling by $3.4 trillion from July 2008 to March 2009. We're talking about a loss of $30,300 per household. So the blue line shows as far as the amount of loss in terms of the value of homes. Dotted line shows as far as the value of stocks owned by American families. It fell $7.4 trillion between the period of July 2008 to March 2009. On average, we're talking about a loss of over $66,000 per household. These charts that I just showed you, this is a graph that shows you not only the total impact, but on a per household basis. For example, fiscal cost, how much it costs every household, $2,050. May not seem a lot, but if there's somebody who's lost their job or has children and they've got to be more concerned about putting food on the table as opposed to try and pay the fiscal costs of this financial crisis, that's where the problem is. Stock wealth, a lot of people lost a lot of money. As I said before, an average of over $66,000. The value of real estate went down over $30,000. And this is, again, on the per household basis. In wages, total lost wages came out to be $3,250 per household. In terms of GDP, $5,800 per household. So the whole idea here is that you had a significant number of people that lost not only their homes, but also wealth. Even if you didn't lose your home, you didn't lose your job, you saw a loss as far as really the value of your home, the value of the stocks, and a lot of people own stocks. Final thoughts. Could it happen again? Yes, I think it could. I think it really, really could. I mean, what we saw with the pandemic was just a shock to the system. The financial crisis was a shock to the system, but it was something that was building up over a period of time. Pandemic was something that happened 1, 2, 3 within a matter of months. The Fed learned a big lesson during the pandemic, which was to put money into the US economy immediately, not after a couple of months, not after a couple of years, but immediately. Put that money in immediately. And what we're seeing now in the financial crisis of 2008, 2009, so we're seeing now as far as the pandemic is concerned, excuse me, as far as the pandemic is concerned, and what the actions of the Fed have been, is really a result as far as what happened with the financial crisis of 2008, 2009. But it could happen again. Now's your chance. What questions do you have?
Arthur, thank you very much. That was, wow, it was impressive.
If I can use the term sobering?
Yeah, definitely sobering. But I still feel that we seem to be in an economic crisis starting, say, 2019, 2020, 2021. We still see that 40%, that 1% of the population owns more than 40% of the wealth. We have housing now that's, the prices are going through the roof, and there seems to be a shortage of single family housing now, and there are bidding wars on each sale of the home. It does seem to be very unstable at the moment. We still seem to have a loss of wages, or certainly not a gain in wages. I don't know. What are your thoughts?
A couple of things. I do agree with you that you still have the rich getting richer and the poor getting poorer. That there's an uneven distribution as far as income and wealth within the United States is concerned. The only way, or one of the key ways in which there can be more of a level playing field in terms of the distribution of wealth and income in the United States, is through certain types of tax plans, taxing the wealthy. You know, there are those that say, oh no, you shouldn't tax the wealthy. No, you have to. If you want to have a level playing field between the wealthy and everybody else, then you're going to have to introduce higher taxes. And that's what the Biden administration has already stated that they want to do. They want to do certain taxes that would tax the wealthy. The other point that you had regarding home prices, what we're seeing now, and it's not just with home prices, it's with a lot of other commodities, with different items, for want of a better term, that we saw the US economy and the global economy shut down last year. We saw it shut down last year up until about a few months into this year, 2021. The US economy is starting to open up now, okay? That's why you have this situation regarding home prices. People have this pent-up demand and that they want to buy a home. They want to spend. So you're having prices go up. This inflation rate that we're seeing now should have happened a long time ago. Housing demand is going up because people want to move. You're going to see a lot of people are going to be wanting to relocate for a variety of reasons. But here's where it's different this time than last time. That is financial crisis of 2008, 2009. In the financial crisis of 2008, 2009, people were speculating with their homes. Flip this house, using their houses as ATM machines, okay? We're not seeing that now. What we're seeing is that people want to move because maybe they've got this money saved up and now they want to buy a house, or they want to get out of the city and they want to go into the suburbs. But this is something they've been wanting to do for a long period of time, and now they're able to do it. Housing prices are going up, but it's not because of what we saw in the financial crisis of 2008, 2009. It's a totally different scenario. It's a totally different situation. Housing prices will eventually come down, but they're not going to crash. This is what you saw in 2007, 2008, and 2009. I hope that answers your question. For your time, for attending, for listening, thank you very much.